To what do you attribute what has been a red-hot last few months for most Chinese stocks?
Yeah, I think there's a couple things going on, Brian. First of all, the valuations in the Chinese equity space were very, very heavily sold down. There were a number of issues. In addition to COVID-19, there was also the issues of regulatory reform in a number of sectors, like in the education sector and the internet and e-commerce sector. So there's been a lot of bad news. And I think what's happened is a lot of this is already in the price, and investors are acknowledging that from here the downside risk is quite limited. We've eaten the worst of the returns, and that from here things seem to be stabilizing. As you mentioned earlier, China is backing down on some of its COVID-19 lockdown restrictions. It's becoming more open. Travel restrictions are becoming less stringent. So all of that is sort of helping to push the China market forward after all the pain that we've experienced in the last 12 to 18 months. So we've seen a pretty sharp recovery.
We've had some of the numbers. Well, it's been incredible. I mean, Sarah, we had some of the numbers yesterday, and don't quote me on exactly the numbers, but it was something like of the 2,000 or so stocks in the Shenzhen A index, 200 were up more than 200% off their lows, and the top stock was up 900% off its low. I mean, just incredible numbers, arguably off of some pretty low lows last year. So you just wonder how much sort of more gas is in that tank. Although the Chinese government is probably the only major economy stimulating right now.
That's right. It is the only major world economy that is stimulating, while the rest of the world is in tightening mode. So we think that is certainly a positive. The Chinese government is very committed to restoring growth and balanced growth, not just growth for growth's sake. We're still not out of the woods yet. The COVID-19 policy, the property market as well. I didn't mention that earlier, but that's been a huge headwind on the China market. We've seen defaults in the property market sector at levels that we haven't really seen in the past. But all of that does seem to be bottoming out. We think that earnings stability will come in, down the road. So we have been, amping up our positioning in China but being very specific about what we own. But like you said, we're coming off some very extreme drawdowns.
Get more into that specificity, because there's really three different Chinese markets. You got Shenzhen, you got Shanghai. Those are mainland indexes. Those are primarily owned by domestic Chinese investors. In fact, in many cases, you simply cannot own the stocks directly as an outside non-Chinese investor. Then, of course, you've got the Hang Seng, which are the companies that are listed globally. We can buy them today, tomorrow, whatever. Names that sort of more of our viewers probably know. Is there one part of the Chinese market, Sarah, that you are recommending more than others right now?
Not really. So within each of those pockets, for example, in the offshore China names, or the names that are more accessible to international investors, we do think that the internet e-commerce names look interesting. Those stocks, as you mentioned, have rallied pretty hard over the last 6-8 weeks. But we do think that structurally, with a consumption-driven economy in China, that these types of e-commerce names are very, very important to the Chinese economy. So these are, the e-commerce, internet related names, e-gaming as well, cybersecurity, things like this. Within the domestic market, we're also very bullish on the domestic brands. So whether it be things like sportswear or dairy products, or food and beverage like Baijiu, that alcoholic drink that's like the wine in China, those types of names, which are onshore China names, are also looking very attractive to us.